Fulgent Genetics Q2 2025 financial results, key highlights, and future outlook. Fulgent Genetics just surpassed expectations, but here's the twist no one's talking about. Spoiler alert, the company's second quarter 2025 results reveal a 16% surge in core revenue to $81.7 million, but the GAAP loss of $19 million masks a non-GAAP profit of $2.1 million. Here's where it gets controversial. Should investors celebrate the revenue growth or worry about the GAAP loss? Let's break it down. Fulgent, a biotech giant straddling diagnostics and therapeutic development, announced Q2 2025 financials that highlight both momentum and complexity. Core revenue, essentially revenue excluding pandemic-related testing, jumped 16% year-over-year, pushing the company to revise its full-year guidance upward to $320 million. On the surface, that's a win. But the GAAP loss of $19 million, or 62 cents per share, contrasts sharply with the non-GAAP income of $2.1 million, or 7 cents per share. The discrepancy? A one-time charge and adjustments for intangible asset amortization, equity-based compensation, and investment impairments. And this is the part most people miss. Non-GAAP metrics strip out these costs to focus on core operational performance, but critics argue this can obscure long-term financial health. The cash reserves tell another story. Fulgent ended Q2 with a staggering $777.5 million in cash equivalents, and marketable securities. That's enough to fuel RD, stock repurchases, or strategic acquisitions. The company has already spent $110.4 million repurchasing shares since 2022, a move that boosts shareholder value but could raise eyebrows if cash burn accelerates. Here's the kicker. Management is optimistic about the second half of 2025, projecting a non-GAAP loss of just 35 cents per share. Is this a sign of disciplined cost control, or are they papering over structural challenges? Paul Kim, CFO, called the results a reflection of momentum and employee effort, while CEO Ming Hsieh praised progress in both lab services and therapeutic trials. But the real question is, can Fulgent sustain this growth while balancing its ambitious share buybacks and RD investments? The company's pivot to a precision medicine business model hinges on turning diagnostics into a launchpad for drug development, a strategy that's bold but risky. For investors, the takeaway is twofold. The revenue growth is undeniably strong, but the GAAP loss suggests operational hurdles remain. The non-GAAP figures smooth out these bumps, but they're not a substitute for transparency. So what's your take? Is Fulgent's stock repurchase program a smart move, or could it backfire if cash reserves dwindle? Share your thoughts in the comments below. Why Fulgent Genetics stock surged 8% today? Earnings breakdown. Imagine the stock market, where most investors are feeling glum, but one company's shares are soaring, like a ray of sunshine on a cloudy day. That's exactly what happened with Fulgent Genetics on Friday. In a market where the S&P 500 was down nearly 2%, Fulgent's stock was up a healthy 8% and then some. But here's where it gets controversial. Fulgent's latest earnings report revealed a surprise on the bottom line. While revenue increased by a double-digit 15% to nearly $82 million, net income took a steep dive, decreasing by 56% to just over $2 million. However, analysts had expected even worse results, with a projected loss of 18 cents per share. So, what's the secret behind Fulgent's success? In its earnings release, the company credited diversification. CEO Ming Hsieh highlighted their progress in growing revenue for laboratory services and advancing clinical trials for therapeutic development. This strategy seems to have paid off, especially when considering the company's raised guidance for full year 2025. Management now anticipates core revenue, excluding COVID-related products and services, of around $320 million and an adjusted net loss of 35 cents per share. These numbers surpass pundit projections, which is a positive sign for investors. But here's the part most people miss. Fulgent Genetics isn't on the Motley Fool's list of the top 10 stocks to buy right now. While Fulgent has shown impressive results, the analyst team has identified other stocks with even greater potential. Consider the success stories of Netflix and Nvidia, which made the list in 2004 and 2005, respectively. If you had invested $1,000 in either of these stocks at the time, you'd be sitting on a fortune today. The Motley Fool's stock advisor has an average return of 1,036%, outperforming the S&P 500 by a significant margin. So while Fulgent Genetics may be crushing it, there are other opportunities out there that could produce even more impressive returns. Should you invest in Fulgent Genetics? That's a question only you can answer. But it's worth considering the bigger picture and exploring other investment options that could potentially offer even greater rewards. What do you think? Is Fulgent Genetics a smart investment? Or are there better opportunities elsewhere? Share your thoughts in the comments below.